I'm having an extraordinary amount of difficulty trying to get the last portion of this chapter to record. I've been trying here for 2 days, so done some research on it, and hopefully the things that I've looked at will help me finish this chapter out. One of the things that I've noticed is the longer the videos, the more difficulty it is in getting them to publish in YouTube. So I'm going to try to keep each video somewhere in the range of 20 to 25 minutes. Okay, we'll get started here with the notes receivable section. Notes receivable are a formal credit arrangement between a creditor, which is also known as the lender, and a debtor, which is also known as the borrower. Notes receivable are classified either as current or non-current, depending on the expected collection date. So if it's current, we're talking a year or less. Our examples below will illustrate short-term notes, and then later on in the chapter we'll get into long-term notes. The first type of note we'll talk about is an interest-bearing note, and this note receivable will require a specific payment of the face amount, also called the principal, which will be paid at the maturity date of the note. And then it will also call for interest to be paid at a stated percentage of the face amount. And the way that the interest is calculated, we see in the calculation right here, the expression face amount or the principal, which is borrowed, times the annual rate. That would be the annual rate of interest, and then the fractional period of that 12-month period, since it's a short term or current note receivable. Our illustration works with Stridewell Wholesale Shoe Company. They manufacture and sell shoes to retailers. And on May 1st, 2016, the company sold shoes to Harmon Sporting Goods, and Stridewell agreed to accept as initial exchange for the shoes a $700,000 note, 6-month note, 12% interest, and the interest is payable at the maturity after the 6 months. We're going to assume that the interest rate of 12% is appropriate for a note of this type, so that would be at fair value since it's appropriate for the note of this type. So on May 1st, the initial date of the transaction, Stridewell records a note receivable for $700,000. That'll be on the balance sheet. It's an asset account. They'll record a $700,000 credit to sales revenue. That's on your income statement. It's a revenue type of account. 6 months later, November 1st, Harmon Sporting Goods needs to pay Stridewell for that note. So they're going to Stridewell's going to debit cash for $742,000. That's a $700,000 face amount plus $42,000 in interest, and we'll calculate the interest amount here in the next line item. That interest revenue is calculated, $42,000, as $700,000 face or principal amount times the 12% interest rate, that's an annual rate, and we're going to multiply that by 6 months, or the fraction 6 over 12 months. And that calculates out to $42,000 that's credited to interest revenue. The note receivable gets credited for $700,000, which zeroes out its initial debit from May 1st. Now, if the sale occurs on August 1st as opposed to May 1st, then our year-end December 31 period is going to be straddled by the term of the note. So what we have to do when that's occurring is when December 31 hits, we have to accrue any interest up to that day, even though the note has not matured. So we're going to debit interest receivable on December 31st, representing the 5 months that have occurred from August 1 through December 31st. So we're debiting interest receivable for $35,000, and we'll credit interest revenue on the income statement for $35,000. Again, that calculation is $700,000 face amount multiplied by the 12% interest rate, and for 5 months, or 5/12 is the fraction. 1 month later, on February 1st, Stridewell is going to collect the cash, and they're going to collect $742,000, just like we did up above on the previous 6-month note calculation. However, they will have 1 month of interest credited to the income statement, the $7,000. You'll see that $700,000 face amount times 12% times 1 over 12 to represent the month of January of 2017. The other $35,000 we already accrued at December 31st in the interest receivable account, so we'll credit that to zero it out. And we'll credit the note receivable for $700,000 to zero it out. Now the next section, non-interest bearing notes, that name is a misnomer as it's stated there in the second line. And that's because non-interest bearing notes actually do have interest. Because whenever you have money, whenever you have time involved, you're going to have interest involved. And that interest is going to be deducted from the face amount or the principal amount to determine the cash proceeds made to the borrower at the beginning of this transaction. So our example here, we see 6 months note. It's a $700,000 non-interest bearing note with a 12% discount rate. So we're going to take the $700,000 face amount, multiply it by the 12% interest rate, times 1/2 or 6 months out of a 12-month year. And that calculates out to $42,000. That $42,000 represents the interest that will be discounted at the beginning of this transaction. And the selling price of the shoes is the difference between the face amount of the note, $700,000, the interest amount is subtracted, $42,000, and we end up what the selling price of the shoes are at $658,000. Sometimes this term discount rate can be used interchangeably, or it's synonymous with effective interest rate with respect to non-interest bearing notes. Now, on a May 1st, 2016 sale, the transaction would be recorded as follows, with the information that we were just given in the paragraph. The note receivable face amount would be debited for $700,000. We would credit the $42,000 discount to an account called Discount on Notes Receivable. This is a contra asset account related to the note receivable. You can see that it's contra and it has opposite side balances, a debit for the note, a credit for the discount. The sales revenue, or the difference between the two, as we noted above in the paragraph, is credited for $658,000. Now, 6 months later, on November 1st, when it's time to get the cash payment for this note, we make the following entries. We're going to go ahead and recognize that interest revenue for the 6-month period. We'll zero out that initial discount amount, that $42,000 credit, by debiting the discount on November 1st, discount on note receivable for $42,000, and credit the income statement in the interest revenue account for $42,000. Cash will get debited for $700,000, and notes receivable will get credited for $700,000, which will zero out its initial debit entry on May 1st. Now that discount, it represents interest revenue in a non-interest bearing note. So again, whenever there's time, whenever there's money, you're going to have interest. And again, it says here that the discount represents future interest revenue that will be recognized as it's earned over the time of the note. The effective interest rate on this note, the example we just did, actually is a little higher than 12%. We'll go through the calculations to show that. You'll see that here's the interest amount for 6 months, $42,000. We divide that by the sales revenue under this arrangement, which is $658,000. And when you do that division, you get 6.383%, which is the rate for 6 months. To annualize it, we multiply that 6 months by 2, and we get an effective interest rate of 12.766%. You see some time value calculations here that you can use with your calculator. If you have a time value calculator and you would like to try to use that, I'd be happy to walk you through the steps. Also, there is an Excel function here that will show you how to do the same calculations. Again, if you are in the Excel, have taken the Excel class, you should be somewhat apparent of those calculations. If not, I'd be happy to walk you through the Excel calculations as well. In this illustration that we just did, if the sale occurs on August 1st rather than May, then it's going to straddle that December 31st year-end period. And here we have to go through the same that we did, same entries that we did with the interest-bearing note. You'll see December 31st, we'll go ahead and accrue any interest revenue, and that's for the 5 months for August through December. And that's simply the $700,000 face amount of the note times 12% times the fraction 5/12, so represent the 5 months for August through December. That calculates out to $35,000 interest revenue, and we'll debit the discount on $35,000, which will lower its balance on the balance sheet. On February 1, 1 month later, we'll go ahead and make that final month interest calculation, which is $700,000 times 12% times the fraction 1/12 to represent the 1 month of January of 17. And we'll go ahead and debit the discount on notes receivable, which will zero its balance out. And the final entry is to make the cash entry, where we debit cash for $700,000 and credit notes receivable for $700,000, which will zero its account out. Now again, this discount account is a contra asset to the notes receivable. And you'll see that in this next statement underneath it on the balance sheet for December 31st, 2016, the note receivable is shown at $693,000, which is the face amount of $700,000 less the remaining discount of $7,000 that got booked to revenue in the first month of 2017. The next section is long-term notes receivable, and we account for long-term notes receivable basically the same way we do for short-term notes receivable. The only difference here is that we have more time value of money issues involved. And we're going to go ahead and continue with Stridewell, the shoe company. In this situation, we're going to have a 2-year non-interest bearing note. And on January 1, 2016, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to a $700,000 2-year note in payment for the shoes, and assuming a 12% effective interest rate, Stridewell would make the following entries January 1 of 2016. They'd go ahead and debit notes receivable for $700,000. Now, to calculate the sales revenue, we have to use our time value tables. And you'll see down here with the double asterisk footnote, we're going to calculate what that $700,000 worth of notes receivable would do in 2 years is worth in present day. So we're going to take $700,000 times the present value factor of $1 for number of periods 2 and for interest rate 12%. And when you find that factor in your table, multiply it by 700,000, you'll get $558,036. That's the number you see in red. That's sales revenue on the income statement. The difference between that number and the $700,000 notes receivable amount that's debited to the balance sheet is your discount amount on the note receivable, $141,964. That amount is going to represent the interest revenue that will be recorded over the 2-year note. At the end of the first year, December 31st, 2016, we're going to go ahead and record the first year's interest, and we'll do that by debiting the discount account for $66,964 and crediting interest revenue for the same amount. That amount is calculated by taking the present value of the note, $558,036 at the January 1 date, and multiplying it by 12%, and that will give you $66,964. At the end of 2017, December 31st, we'll have to do the same calculation, but the carrying value of the note has increased by adding together the $558,036 initial carrying value, and by adding the $66,964 amount that we actually reduced the discount for after that first year. You see those two added together. That carrying value of the note after the end of the first year times the 12% gives us the interest revenue to record in the second year, and that accounts to $75,000. So we'll debit the discount for that amount, credit the interest revenue, and when we debit the discount for that, you'll see that that amount in the initial balance will zero out. When we receive the cash, we'll debit cash for $700,000, and we'll credit notes receivable for $700,000, which will zero out its initial entry on January 1. You'll see down below here the time value calculations with your calculator, and you'll have it down here with Excel too. And in the paragraph that follows here, essentially everything I said with the journal entries up above is mentioned here in this paragraph. And you'll see this phrase in the chapter, the net note receivable. And that's your note receivable on the balance sheet minus the contra account, the discount on notes receivable. So whenever you see this phrase, like it shows right here, the net note receivable as of the beginning of the period, that's what you're looking at, is that calculation of taking the note receivable balance and subtracting out the contra account balance, the discount on notes receivable. And you'll see here in this section, in this paragraph here, you'll see the $66,964 amount in blue. It's also up in blue in the journal entries that helps you correlate the paragraph to what I explained up above. And you'll see that down here where I have the pointer here, that it reduces the discount on the note receivable to 0 by the end of 2017, as I explained up above in the journal entries. And at that point, the book value of the note, sometimes also called the carrying amount or the carrying value, is $700,000, and that's the amount of the cash that's collected and zeroes out that note receivable. The type of method that we used in calculating the interest is the effective interest method, and by which we calculate interest revenue by multiplying the outstanding balance on the long-term receivable, which is the carrying value on the balance sheet, and multiply it by the effective interest rate. And that's the way we will do our time value calculations, the effective interest method. We'll talk more about long-term notes receivable in Chapter 14, as it mentions here in the next paragraph. You'll have to disclose your notes receivable in your footnotes to the financial statements, and we see an example here from Marriott International. There's nothing too complicated in this note. You just basically explain the principles that you have involving your notes receivable, and just so you have some additional information for the readers of the financial statements, in addition to the amounts that you have reported in your financial statements. The next section is notes received solely for cash. And I'm getting close to my 20 minutes. I see here in my mirror I'm using, I'm at 17 minutes and 45 seconds, so I'm about ready to cut this off. So notes received solely for cash. If a note with an unrealistic interest rate, even a non-interest bearing note, is received solely in exchange for cash, we consider that cash to be the note's present value. So in our example here below, if the non-interest bearing note in the previous example had been received solely in exchange for $700,000 in cash, then that transaction would be recorded as follows. You see the debit here to notes receivable for the face amount, $700,000, and a credit to cash for $700,000. Now the subsequent valuation of notes receivable is similar to what we do for accounts receivable. Now, a company is going to anticipate bad debts on short-term notes receivable, and it will use an allowance account to reduce those notes receivable to the net realizable value. This is the same process that we use in accounts receivable. Long-term notes, though, present a more significant measure problem because the longer the duration of the note, the more likely there are bad debt, and sometimes there's difficulty in measuring these bad debts, and this faces banks and other lending institutions in trying to come up with an estimate of the bad debts on their long-term notes and loans. You see Wells Fargo here has a section of their 2013 balance sheet where they estimated the allowance for loan losses at $14,502 million. That's subtracted from their loan portfolio, and to give them the net loan amount on their balance sheet at $811,297 million. Wells Fargo also has a disclosure that they have to report for the allowance of loan losses, and you see an example of how they would narrate that there. Now, GAAP requires that companies disclose the fair value of their notes receivable in their disclosure notes. Also, companies can choose to carry the receivables at fair value in their balance sheets, with changes in the fair value recognized as gains or losses in the income statement. We'll talk more about that in Chapter 12. When it becomes probable that a creditor will be unable to collect all the amount due to according to the contractual terms of a note, then that receivable is considered to be impaired. And when you have an impaired receivable, what you try to do is to remeasure it at the present value of the expected cash flows you anticipate getting out of it, discounted at the loan's original effective rate of interest. Now, a section here next where we're headed, this won't happen till 2017 at the earliest, but it warrants mentioning here about some additional guidance to give companies to help calculate their current expected credit loss. It's a model to account for these bad debts or credit losses on long-term notes receivable. There's a couple areas down here that I've highlighted that will tell you how to go about calculating the estimate for bad debts on long-term notes receivable. I think I'm going to stop it right here, and hopefully that it will record and I can be able to post this very shortly.